Stay where you are. We've got Richard Fisher here. We're going to bring him into this conversation. Former Dallas Fed president, a CNBC contributor. I want to get to what the Fed is going to do, but I want to start with this, Richard, which is just contextualize this for the audience. It's 6:10 in the morning on a Monday morning after what was a wild weekend. A lot of people comparing it to 2008. I don't think that's necessarily the right comparison, but you know, Steve had a smart question. We've now asked it a couple times throughout the broadcast. Is this a Bear Stearns weekend, meaning it's a precursor to something bigger? Has the tide been stemmed here, and what the government's done has ended this for good? What do you think?
First, we know that Becky's responsible for the bank run, by the way, by taking her money and putting it in the Treasury. Look, Bear Stearns didn't have deposits. And it's different from 2008, 2009, when I was on the Open Market Committee. I think it's better to go back and look at the Texas banking crisis in the 1980s. And even to Little Penn Square Bank, when it failed, remember, because of it, which was small in size, Continental, Illinois failed.
Yep.
And there was a knock effect. So that's
the first time the phrase too big to fail was ever used, Continental, Illinois.
Exactly. And don't forget, even though we didn't have interstate banking, InterFirst Bank that failed in Texas in the 80s was the 6th largest bank in the United States at the time. So they did have deposits. You could go back and look how they were worked out. And I am of the, even though they've taken, as Steve just referred, as stated differently, duration risk out of the banks by offering 100 cents on the dollar on the U.S. Treasuries. I don't think that they should be pausing the 25 basis point hike. So I agree with Mohamed Al-Arian. I do think they came up with a program that is responsible vis-a-vis the depositors. The equity owners, the bond owners will be wiped out. That's appropriate. And the one thing you can count on, Andrew, we're going to see a lot of criminal allegations with regard to the management of both banks.
Right. Okay, but what about, there's a whole
bunch of... We're going to have a lot of turmoil going forward, but I would say this.
There's a whole bunch of smaller banks now that people are focused on two fronts. One is, has the work that the Fed and Treasury done prevented the flight of deposits from those banks? Are we going to continue to see any flight? I imagine you might see some, but you look at First Republic, you look at some of the other ones that we had on the screen earlier, and you say to yourself, are there transactions that over the next year are going to have to happen? They may not have to be gunshot deals the way we had all these sort of weekend deals, because now maybe they have a little more time. But what happens to those institutions?
Well, there's going to be acquisitions and failures. I don't see any. This is an extreme circumstance. This is a black swan. There's always a black swan swimming in the lake. You don't see it until it happens. And yet it is being contained. It's both a plus and a minus, the way the authorities are dealing with, the Fed is dealing with it. And that is that reassuring people over the insurance
Richard,
level.
But
there's always going to be doubt, Andrew. And I think we're going to see more movement into money market funds, particularly Treasury driven, and more action like Becky's. But I don't think it bring down the bank.